Hello, everyone. Welcome to our channel where we dive into economic trends and forecasts. Today, we're exploring a fascinating comparison between the UK and Japan, focusing on potential economic paths due to similar challenges they face. Stick around to understand how this could affect your investments and the broader economic landscape. Let's start by looking at Japan. Over the past 4 years, the US dollar to Japanese yen has appreciated by 50%, despite Japan having a net current account surplus. Currencies normally do not depreciate at this rate. If you are a Japanese citizen with lots of savings in your yen account, then your net worth in terms of purchasing power is halved. This is a chart which shows the yen versus gold. Here over the last 10 years, gold in yen terms has almost tripled. This is because gold has also risen against the US dollar. In other words, the dollar has devalued against gold and yen has devalued against the US dollar. This anomaly primarily stems from Japan's high debt levels and its low interest rates, which they have kept low for long periods of time in spite of rising inflation. This, coupled with an aging population and minimal immigration. Japan's population is predicted to fall over the next 50 years. These factors contribute to a weaker yen and stagnant economic growth. Now, let's pivot to the UK. The UK shares some similar risks with Japan, notably high debt levels. If we include unfunded pension liabilities, the UK's debt to GDP ratio could skyrocket to 300%. This is not well known and kept hidden from the mainstream media. Like Japan, the UK faces the dilemma of potentially rising inflation, which could necessitate higher interest rates. The Bank of England kept UK interest rates low for almost 15 years following the financial crisis. This, together with QE, which increased the monetary supply, has pushed house prices to unsustainable levels as the wage growth has been relatively timid. Although the Bank of England has raised interest rates to control inflation, this has put tremendous stress on the housing market as people who have bought near the top of the market at low interest rates now find that their mortgages are repriced at much higher rates. Already there are reports of increased defaults in the housing market. So, if inflation continues to be high, the Bank of England has limited room to increase the rates, as if the rates rise any further, it could trigger a collapse in the highly financialized housing market. As it is the banks who have lent for the houses, you will soon find collapse of the banking system. For this reason, we believe that the Bank of England will keep their rates at current levels or even cut them if there is an economic recession. The situation is different in the US. The record government spending on infrastructure to reshore critical industries to the US from China, together with record immigration, estimated at 8 million, will keep US GDP growing, and their central bank is less likely to cut rates. Capital always follows the yield, and if it can get better interest rates in a different currency, then the capital will move from the low-yielding currency to the higher-yielding currency. This is the reason why the Japanese yen has fallen so much against the US dollar. We think that if the same were to happen in the UK, then the pound has potential to fall significantly similar to the Japanese yen. Given these challenges, the UK might be forced to keep interest rates low, mirroring Japan's strategy. This is particularly likely because higher interest rates in the US make the dollar a more attractive investment. Money tends to flow towards higher yields, and if the UK doesn't compete with these rates, the pound could see a significant depreciation. Despite better demographics due to rising immigration, the UK's current account deficit, as a net importer, places additional pressure on the pound. If capital begins to flow out of the UK, looking for better returns elsewhere, the pound could potentially follow the yen's downward trajectory. As we can see from the Japanese example, If a Japanese citizen had majority of his net worth in gold, he would have been in a much better position compared to a person holding all his savings in the yen. People in the UK should also do the same. While we are not so bearish on the pound compared to the yen, we still think that the pound will fall against the US dollar, and one way to protect ourselves from pound devaluation is to hold gold. Another way is to hold shares in US companies or UK companies with earnings abroad. A lot of FTSE companies earn the majority of their income in US dollars. Although not well known, the pound has been gradually falling over the last 100 years. If we look at the pound versus the Swiss franc, over the last 20 years, the pound has devalued by nearly 50%. This is because of quantitative easing embarked by the Bank of England after the financial crisis. The Swiss Central Bank, on the other hand, did not do quantitative easing. So, what can the UK do to avoid Japan's fate? Economic reforms, including increasing government spending on infrastructure, boosting productivity, and enhancing demographic policies to support a sustainable working-age population could be key. Additionally, managing the housing market and debt levels responsibly will be crucial to maintain economic stability. As we've seen, while the UK and Japan have distinct differences, the similarities in their economic challenges provide crucial lessons. For the UK, learning from Japan's prolonged stagnation could help in making proactive policy decisions to secure a more stable economic future. Thank you for watching. If you found this analysis helpful, please like, subscribe, and share this video. Don't forget to comment below with your thoughts or questions. See you in the next video.